So, so I guess financial case for financial health, the business case for financial health. So this session was organized by the From Research to Practice Action Group of the European Microfinance Platform. The group was formed with let me say, three main objectives. The first one is to foster collaboration between academics and practitioners. The second one was to support research by, for example, funding, new sources of data. And the last one, probably the most important, where we have spent most of our time and effort, is in translating the result of scientific research into practical implications. A couple of years ago, we conducted a survey among practitioners on their main research needs, and at the top there was a digital financial education. Well, by delving into that, we realized that digital financial education is really connected to financial health, because financial health is an outcome of, for example, financial capabilities, financial knowledge, but also behaviors, attitudes, and as well as other factors. So the last year, for example, what we did was to explore the connection between financial education and financial health. But after that, we realized, also based on some interchanges with practitioners, that before moving forward, we needed to build a business case for financial health, because we realized that some practitioners, for example, said that they have, for example, difficulties and challenges in involving FSPs into taking a financial health approach. Okay, so Max, can you please tell us? Okay, so Max is a consultant, is a friend. So we have founded a group together 3 years ago, and so my first question for you is, why building a business case for financial health is so important?
Thank you, Davide. And can you hear me well?
Yeah. No. I think it's...
No? Hello? Yeah? Perfect. Thank you. Thank you, Davide. Yes, we started working on developing this theoretical framework, which now seems to be more like a plan. But hopefully we can, next year implement some actions or projects implementing this framework. And this is a framework which is very, logical, where we put the financial health of customers, of financial service providers, at the center. And of course, it has to be an understanding from financial service providers what financial health really means. And then when they understand that and commit to that, they can start investing in developing or strengthening the financial health of their customers. And we are proposing that will bring benefits for their customers, but also benefits for the institutions at different levels, right? Mainly financial performance. But also we know that financial health is also influenced or could be influenced by other factors, external factors that could be regulation, innovation, and technology, right? So we need also to take into consideration those factors. So this is basically what we consider is important in building this. But also our main message is bringing benefits for the FSPs by introducing or strengthening the financial health of their customers.
Okay, and so what is the key part of this framework?
Well, as you can see in our framework, we put financial health of the customers right at the center. So you can see here that we're proposing to really understand what we mean by financial health, as I said. And financial health is an outcome. right? Is a result of a process. And we start from the financial capabilities of these, of the customers, but financial capabilities going beyond financial literacy, right? Capabilities that can also address the knowledge and skills of the customers, and how the interplay of skills and knowledge of the customers can also bring other benefits, like developing a better financial confidence when they are making decisions, when they are using financial services, and also how they develop attitudes towards the use of the money. And then we move to the financial behaviors that also these customers do and interact with FSPs. And FSPs are more familiar to financial behaviors because these are related to the core activities that financial service providers do, you know, savings, credit, investment, insurance. So that they are more, you know, in interaction with the customers, but also they need to understand how these behaviors are developed through this process. And then that will lead to what we understand as financial health, right? And financial health looking at 4 specific dimensions, which is our understanding and the understanding of many institutions about financial health. One is financial security as the ability to meet short-term commitments, financial resilience as the ability to cope with unexpected or adverse events, financial control is confidence in one's current and future finances, and financial freedom as the ability to meet long-term financial goals and desires. And this, of course, as I said, is also influenced by other external factors, which are not in the control of the FSPs, because that has to be with, you know, inflation, employment conditions, other macroeconomic factors are influencing as well the financial health of the customers. But at a certain level, financial FSPs can also really focus on that and develop that understanding.
Okay, then, so what do FSPs need to do to achieve this, to contribute to the financial health of their clients?
Yes, I think I'm going to move to the next one. So what inputs can FSPs bring into this framework? Well, this is something very important. First is to develop a corporate vision. So having the understanding of financial health and really committing to it, I think is very important in our proposal, that the vision and, you know, the commitment to financial health needs to come from the top and go down through the organization to understand that by implementing and developing the financial health of the clients will bring benefits internally to the organization. And that a proposition we are making is to invest in more financial capabilities. As I said, going beyond financial literacy, but understanding how the financial capabilities of their clients can develop through interaction with other factors as well, you know, including social, you know, interactions with their communities, understanding also the fluctuations in their businesses, how they develop those skills and knowledge through also past experiences or information shared by the peers, either in their communities or in other settings. Also, there is another important aspect, which is the developing services and products focused on these profiles and needs of the customers. And then is when financial health is not just an additional activity to work with the clients, but needs to come from the outset of the operations of the FSPs. So, you know, using more human-centered design tools to develop these more focused services and products that can improve the capabilities and behaviors of the clients, and also implement other aspects like clients protection, right? Some institutions, they need to comply with regulation, but also they need to develop and that commitment to protect their clients in this framework of financial health. And of course, here is something very important, that financial FSPs, they need to measure this, right? They need to bring all these developments of the financial health of their clients into a way to measure how that financial health is either in the beginning of their implementation, and then to start measuring how that is improving, through their time and across their activities and strategies.
Well, let me say that one of the barriers that we have encountered in our journey is actually, the most FSPs, they are reluctant in measuring financial health because they don't see the benefits. So what benefits can FSPs reap from this kind of new paradigm?
Yes. And perhaps this is the most important part of our pitch, what FSPs can benefit from implementing this approach, improving the financial health of the clients. Well, the first one, as I said, is the outcomes on their customers, right? And we have talked about developing financial capabilities, financial behaviors, and leading to financial health, which that will improve the quality of different characteristics of the clients. For example, in terms of financial capabilities, having people with a better understanding of the financial supply, the financial services and products they have available in the market, they will make more informed decisions about how to use and what to use more appropriate for the different needs during the cycle. Also, behaviors. For FSPs, it's very important to influence behaviors so people, can respond to what they're offering. It's not just about, taking a credit or opening a savings account, but it's also understanding their relationship with the financial institution and knowing that that financial institution is also doing something to make them feel, more resilient, to enjoy, the decisions they make to meet the short and long-term needs, and also, as we discussed early in the first session this morning, resilience is something very important for FSPs to get involved with their clients, to make their clients more resilient. So clients, as we said, is very important to get that and improve that financial health. So we have this process of moving from financial capabilities to financial behaviors, and finally getting a better or more improved financial health.
So thank you very much, Max. So if I got it well, so improving the financial well-being of clients will have important impacts on the financial performance of FSPs.
Yes.
Yes.
And that's one part that, yes, is very important in this presentation, which FSPs that can, develop all this approach, we believe they will have different benefits at the institutional level. One of them being improving their reputation. And reputation and competitive advantage in the market is something now, in very competitive markets, which is a very positive aspect. Also is loyalty of their clients. When clients engage with the FSPs and they understand that the FSPs are looking after the financial health, they are doing activities or doing actions to improve that financial health and reduce the financial stress, they will probably recommend that financial institution to others. So they can reduce the customer acquisition cost. Also, they have possibility to do cross-selling, right? And by having more sophisticated users, they can also offer other products that are, not just credit, but also, they can understand what are the benefits of having an insurance policy or invest in other services. And that will bring other benefits as well, like having clients that, they manage better their accounts, they save instead of taking a loan, or they take insurance policy. They will be more profitable clients, more satisfied clients that can bring larger balances to the financial institutions. And that will have an impact on the financial performance of the institution.
Sure.
And just to end is the credit risk. Of course, all the FSPs are worried about, concerned about the risk of their clients. Having clients with these profiles will be less risky than, not having these interventions.
Okay, thank you very much, Max. So for sure, having clients that are more financially healthy, so that is going to improve, to increase, for example, the stability of savings, of deposits over time, the amount of deposits, a better quality of the loan portfolio. Yes, okay, this is a theoretical framework, right? So, but we need to make sure that we are on the right path. So let's now introduce our distinguished guest. The first one is Trey Waters from the Financial Health Network in the US. Okay, Trey is a senior manager at Financial Health Network. The Financial Health Network is the leading authority on consumer financial health for business leaders, policymakers, and innovators, united in a mission to improve the financial health of their customers, employees, and communities. Our second guest is Nancy Thomas. She's senior microfinance advisor for the Lendwithcare program run by Care International UK. Lendwithcare is a peer-to-peer microloans platform that raises loan capital for micro and small business owners in low-income countries. Lendwithcare is currently working with 18 FSPs, partners, in 15 countries around the world. And then our last guest is Gabriel Double. Gabriel was responsible for the establishment of the Microfinance Regulatory Council in South Africa, and thereafter for the establishment of the National Credit Regulator. Over the last 10 years, he has done consulting projects in the areas of financial regulation, consumer protection, and SME finance in a number of countries in Africa and Asia. The last time we talked to Gabriel, it was in Cambodia, right? So just to mention one case. Okay. Trey, are with us? Are you with us? Yes.
Can you hear me?
Yes. We know it's very early in US, but I mean, I think you had the opportunity to have a coffee before our speech. So let me start with the first question. So, can promoting the financial well-being of clients serve as a business rationale for financial service providers? And if so, can you provide some cases real cases from your experience?
Sure. Thank you very much, and thank you everyone for joining us today. So in Financial Health Network, so for folks who don't know, we are a financial health organization based in the U.S. That we're working with, as we said, with private sector researchers and government to focus on consumer financial health. Very similar to the framework that we talked earlier, we have something where we look at spend, save, borrow, and plan, and that's how we measure someone's financial health. From there, we started looking at the business case for financial health. We started doing this because more and more companies were coming to us and say, okay, we started measuring, or we're thinking about measuring our financial health, but how do we execute on this? And how do we look at the way that we can be taking this to products? How can we look at this, how we can take it with our internal infrastructure, our strategies, and then also with our people. And so building off of those, we developed something called our Financial Health Assessment Program, or financial health map. And this is very similar to what Max laid out earlier, but this was something we did back in 2021. We broke the categories for that map into, so we had 4 categories for the map. We are looking at an organization's vision, their infrastructure, their performance, and the solutions they offer. So for vision, we're looking at their strategy and how they're thinking about financial health from a strategic perspective, and also how they're defining financial health within that organization. For infrastructure, we're looking at their IT and processes. So how are they collecting data around customer financial health? How is that data being shared to different teams? For performance, we look at staff training. How are they being trained on financial health concepts that were identified during the strategy? How is financial health being embedded in people's job descriptions? And then finally, we look at the solutions that are being offered and how are they taking factors like financial health into account. So how are fees being incorporated in? Because we know that's going to be really expensive for low-income consumers. For us, when we think about a business's approach to financial health, these all are connected. We start with vision, I think, with a lot of times, because it needs to have a clear strategy and some clear definitions. But if there isn't the infrastructure in place, there isn't the kind of people or performance put in place, you can't really get to the solutions part, right? You can have great financial health solutions, but if people aren't trained on the financial concepts or how those financial health solutions work, those will fall apart. So we really do think that, well, each piece of this is really important, and not to just focus on the solutions right off the bat. We've seen this in the US, where we've had a couple of organizations come with us and be like, we want to launch a financial health savings product, and we'll work with them to develop the savings product. But too often that product will not succeed because the other pieces of this infrastructure or the other components of a financial health strategy have not been implemented. So we launched our financial health maturity model in 2021. We've been working with J.D. Power, for anyone that's not familiar with it. They're a leading US market research firm, to develop a financial health certification. And for the last 2 years, Bank of America, the second largest bank in America, has been certified as a financial health company. One of the things I do want to take a pause here and say is, while everything I'm going to be talking about today is very US specific, I do think the overall concepts we're talking about around vision, infrastructure, performance, and solutions can be translated to other contexts. And I'm happy to answer any questions people have about that later on. Coming from before working for a financial health network, I worked for Mercy Corps and META, working in microfinance. So thinking about the conversation today, I would really want to make sure what we are sharing, what we're talking about, was transferable and not too US centric. I will also add that while we've been looking at this overall maturity model, we've also been doing some research into how financial health is, and when businesses that take a financial health approach are translating to the customer level. And we have research that shows that customers that report that their financial service provider takes a financial health centric approach are more likely to increase loyalty to that financial service provider. I think it's 5 times more loyal if they feel that their financial service provider is taking that. We've seen organizations who have taken a financial health approach to have their net promoter scores increase, other customer loyalty pieces increase. We're continuing to do other research to some of the other areas Max mentioned earlier around kind of loan portfolios and savings, and how these different metrics could be implicated or be improved based on taking a more customer-centric approach. But we do already see the impacts of loyalty in the space, even within like the 2 years since we've been focusing on this explicitly. So following up, I wanted to share a couple examples of how this has looked in the United States to date for the audience today. So the first financial service provider I'm going to talk about is BECU. They are a credit union in the United States, which is very similar to a financial cooperative you might see in other places. In about 2018, they started using our financial health framework to measure financial health of their customers or members. And they found that more than half of the credit union's membership was struggling financially. Once they found this, they created a financial health council that championed cross-functional or organizational-wide strategy to align the various departments around a shared goal to drive improved financial health outcomes while also thinking about achieving their business goals. The Financial Health Council involved building an internal model using transactional data to measure the financial health of credit union members and to deepen BECU's understanding of members' financial pain points. They then took this information and started building it into products. So an example that they did was they found that building short-term savings was a challenge that many of their members were having. So they developed something called QuickSave. QuickSave was something they built into their banking platform that when somebody logged in, they could quickly slide over at the bottom to put $1 or $2 aside from their checking account into their savings account. This is something that people could do regularly, and when people are checking their bank account regularly, they could put money aside. Just doing something small and simple like this and having those reoccurring small savings happen people were able to build their financial health, and the ECU was able to see improvements in people's savings. Another example I want to share, which I mentioned earlier, is Bank of America. They're a large financial institution in the US, but back in 2014, they decided to take a customer-centric approach to improve the customer experience more broadly, and also to drive down their operational costs. And part of taking that customer-centric approach was thinking about the customer's financial health. They developed feedback systems to collect data and information from their customers through call centers, through branch staff, and also through surveying their members regularly on the financial challenges and their financial health needs. Some of the changes they made based on this feedback were lowering account fees and their overdraft fees. They've also launched products called Keep the Change, which is a roundup product where every time you make a transaction, a small percentage is rounded up to the nearest dollar, and that money is put into a savings account. They've also developed Erica, which is their chatbot, and then finally they developed Life Plan, which is a goal-setting platform that they use to help their customers meet their financial goals. I will also say that we've seen other lower cost approaches to people building in financial health into their customer engagement. So one of the ways we've seen it is people surveying or asking financial health questions when people come into their branches, and then doing an assessment there based on where someone is in their financial health, and thinking where their potential pain points are, and talking through with that person about how they could be working with them on either building their savings, improving their access to credit, thinking about their long-term planning, or adjusting their spending. I will also just want to say that while my examples today are both from the United States, we have seen this happen in other countries also. Two great examples are the Commonwealth Bank of Australia has taken this approach also, and I really encourage everyone to look at some of the case studies that they have produced on this. And then also Ned Bank in South Africa has also been a leader in this space.
Okay, so thank you very much, Trey. I think there are several takeaways, right? One of them is that loyalty is one of the major benefit that you have observed based on your experience, that designing financial health based products is not that challenging, that there are many solutions, and seems that most of those products, there's some sort of nudges embedded into the products, and that's probably something that we also learned from the last year, right? From the experience of UNCDF on their different projects on improving financial health. Okay, I give you the floor for the next question to Nancy.
Thank you, Davide. Well, now we will bring the perspective from an investor, and we have a couple of questions for Nancy. First one is, how does Lendwithcare, as an investor, supports field partners to strengthen and improve the integration of financial health into their operations? And the second one is, what insights and challenges can Nancy share when promoting a financial well-being perspective among investees? Thank you, Nancy.
Okay, thank you, Max. And good afternoon or good evening. It's very dark now, so it's hard to tell. So yeah, as mentioned in the introduction, Lendwithcare is essentially a crowdfunding platform. And we publish the profiles of micro and small business owners from around the world on the Lendwithcare platform. And we raise the loan funds they require to invest in their income generating activities. And we channel those funds that we raise through the platform through a network of financial service providers, which Davide mentioned. At the moment, we have 18 FSP partners in 15 countries. It's kind of important to mention that context in light of this discussion, since kind of on the surface, the model is quite single focused. It's quite narrow. We raise loan capital, and that kind of is all we do through Lendwithcare. But we do have a broader objective and mission as Lendwithcare, and that is to ultimately improve the economic well-being and resilience of low-income communities, and we have a particular focus on women. Lendwithcare is part of Care International UK, and Care International as a whole One of our core impact areas is women's economic justice, and financial inclusion plays a really important part of that. And one of our 2030 goals is for 50 million women to have equitable access to and control over economic resources. So, you know, big objectives that we're trying to achieve, and they're not being achieved ultimately just through the Lendwithcare platform. But what is it that we do as Lendwithcare, kind of with this context of it being quite single focus or narrow focus? So it's quite multifaceted in terms of how we try to contribute towards these economic well-being aims. The first thing for us is partner selection. So who we work with and the FSPs that we identify is really, really important. There's a really sort of long and thorough due diligence process that we go through in order to identify FSPs that are already can demonstrate that they're already aligned with those outcomes and those missions. So they're things that are already well inbuilt into the FSP's kind of DNA, and it's what they're trying to achieve, and that they can demonstrate through the due diligence process that they have developed or have appropriate and affordable financial and non-financial services that they are providing to low-income, vulnerable, marginalized individuals and communities. And our aim as Lendwithcare then is to work with those partners and use a platform to raise capital that's interest and risk-free to enable those partners to achieve those missions, and importantly to avoid mission drift, which is something that we, you know, can easily happen. So we provide the capital. When I say interest-free, we have the capital is provided through individuals, a network of individuals, and they don't receive a return on their investment. They contribute towards the loan, but they don't make a return on that. And when I say risk-free, our supporters take on the risk of those loans. So if a loan there's a delayed repayment, or it needs to be restructured, or ultimately if that loan needs to be written off, it's passed on to the supporters of Lendwithcare. So these are all quite important aspects of it. But financial responsibility is also important, as well as social responsibility. So when we're doing our due diligence, we're really looking at FSPs that can demonstrate financial responsibility, since we know if financial performance is weak and not strong, not only are they putting their clients' savings at risk, they're also putting staff livelihoods at risk, and they're ultimately putting Lendwithcare lenders' investments at risk. So we have established a number of benchmarks that we measure potential FSPs against, and these will include common things like portfolio at risk 30 that must be 10% or below, operational self-sufficiency over 90%. We have a number of benchmarks that we use. So that's really important. Selecting the partners is really critical to helping us achieve those aims. Secondly, the funding that we provide through Lendwithcare comes with financial and social expectations that we continually monitor and assess throughout the lifespan of a partnership. So Lendwithcare partners must comply with our social and financial eligibility criteria, but we've also outlined a number of desirable and undesirable practices and a code of conduct that our partners have agreed to adhere to, and we would monitor throughout the partnership. These can include things like demonstrating that they've taken measures to ensure that clients understand the terms and conditions of the loans, and we back that up through client interviews when we visit our partners and do assessments of our partners, that we check that the financial products they're providing are fairly priced. So we do assessments on the cost of the financial products, and also that they're in line with kind of industry standards. We also would expect partners to have policies and processes in place to prevent client over-indebtedness, and that they have action plans for when signs of over-indebtedness show themselves. We do field visits as well as part of those ongoing assessments and monitoring of the partnership. And during those field visits, we may look at things, for example, like staff incentives, like what's the pay structure? Our partner staff, if a partner is 50% or more of a staff salary is driven by incentives, that may raise a red flag for us, as well as the bonus scheme. Is it driven purely by the number of disbursements and not portfolio quality? Again, it's something that we would look at and discuss with our partners. So it's not necessarily to say that we would turn the funding tap off at those stages, but there are certainly things that we would identify as a potential risk in terms of harm being caused to customers and ultimately their economic well-being or financial health. And we would then talk to our partners and work with them to kind of address those gaps. And then the other area I think that we try to work on to try and improve or contribute towards these financial health outcomes is facilitating collaboration. So as I mentioned, we raise loan capital. That's kind of all we have. We are a charity, so we don't have huge amounts of funding ourselves. So we really try to lean on our networks and establish that opportunity for our partners to kind of learn and develop experience and expertise amongst these networks. So, for example, we've funded and co-funded in the past social and financial ratings for our partners, which is a really good opportunity to empower partners to see not only their strengths, but where there's gaps and where they could develop kind of bespoke action plans for our partners to address those gaps. We've been working for many years now with the university in the UK to design and implement an impact study. So like you say, understanding is really important and something that's not always easy to implement for our partners because of the cost associated with it. So we've been working with the university to do a longitudinal impact study with a few of our partners, where we're looking over a number of years at what's changing for those customers in terms of obviously business growth, income levels of the household, but also we are asking questions around perceptions. So how customers are feeling about their financial situation, and importantly, how they feel about the future. So we're collecting that information through this work with the university and sharing it with our partners. And as I mentioned, we're part of Care International. So Care is working in over 100 countries around the world and does a lot of work around economic justice and financial inclusion. So we work, Lendwithcare is kind of adding an extra component to some of that work by trying to link in our partners with existing programming. So one of the big areas of work that Care has been doing and has been championing for decades is village savings and loans groups, which is, if people are familiar with it, is a more savings-led approach to financial inclusion. And we've been using Lendwithcare financing to link some of those groups that are now ready to access more formal finance with partners that we've identified. But we use our finance to kind of negotiate and put pressure on the financial service providers to develop products that are really suited to those savings groups. So that's been something that we've been able to do, as well as linking some financial service provider customers with digital applications. So there's a digital application that Care's developed, which is for those savings groups to start creating a credit history for the savings groups, which is, again, has been quite useful to convince financial service providers to provide, to onboard those groups onto their customer base. And then, we're not the experts. The financial service providers are the ones that know their customers, and they're the ones that are working day in, day out on the ground with the community. So what we try to do with limited resources is actually facilitate peer-to-peer learning, and that's really critical. So we have over the years had a number of online and sometimes in-person workshops where actually we give the floor to the partners to discuss successes, challenges, and to learn from one another. I think that's been really important. So that's a bit of a very quick overview as to kind of how we work with financial service providers ultimately to try and achieve those objectives around financial health or economic well-being. In terms of challenges, my experience, I've been working on Lendwithcare for 10 years, and my experience tells me that they do kind of recognize the importance. It might not be using the same language. I think that's something to think about. And I think the work that this working group is doing is really important, because actually it's not necessarily the language that our partners are using, but they understand the importance of financial health amongst their customers. But there are challenges. The one thing I hear often is cost being a big barrier. So it's definitely the perception that to provide those key additional services that we might think would be important, whether it's financial literacy or education or mentoring, or to really build and strengthen financial health. It's seen as something that's quite expensive by financial service providers, and that can be a real barrier. And some of our partners are doing this work. They are providing those kind of additional services to their customers outside of the more traditional products. But our partners, we need to recognize that they're working in really challenging contexts, and whether it's political and economic instability, if it's the impacts of climate change. I mean, we work in Palestine right now. There's a war, and so it can be really difficult to put forward the case, I suppose, of making it a budget priority, financial health, and having the services that are required to really build and strengthen that. So I think cost is one. And then the other one, just finally, I'm probably gone over time, is around, I think, maybe a challenge around kind of the skills and the in-house skills and knowledge that might be required to really make a difference in terms of financial health outcomes. Because again, my experience has been that where partners are providing that additional those additional support services with their customers, financial education, financial literacy, business management skills, the training around the importance of saving, all those really key things, they're often being delivered by the loan officers or by the field staff who already have a big, quite a busy workload, are already trying to do quite a lot and under a lot of pressure to, help the organization achieve sustainability with its growth, essentially. And I'm not necessarily sure that they're the best people to be delivering those additional services, but also the best people to be identifying where there's financial health challenges and providing the mentorship or the advice that's necessary. So I think that's a key challenge, something to think about, like who should be doing this within the organizations, and then obviously more broadly, whose responsibility is it outside of FSPs? And I do think that's another important thing to consider, and this work will really help us take that forward, I think.
Thank you, Nancy.
Thank you very much, Nancy. Thank you very much, because the effort we're making is actually to connect the dots, even if we use different language, right? We are also exploring local solutions, because you said there are many barriers, right? Including, the lack of skills, but also the cost implied into implementing a financial health approach into FSPs. And I also like very much that you mentioned the role of savings. So at the University of Bergamo, for example, we publish a journal that is called Savings and Development, because we really want to stress the role of savings in financial inclusion. Most of the microfinance sector has been based on credit, right? So the role of savings have been neglected for many years, but it's key into building resilience of clients. Okay, now, now we want also to look, this framework from the perspective of a regulator, or the experience of a consultant in regulation, such as Daniel. Sorry, Gabriel. Sorry, sorry, my.
It's the regulator.
It's too late, also for me. Sorry, Gabriel. So in what ways can the regulatory framework and the conduct of the regulator play a role in establishing a compelling business case for prioritizing financial health?
Good. Let me first warn you. I'm looking at everything from a regulatory perspective, which is negative. What can go wrong? And secondly, my favorite author is Machiavelli.
Oh, great.
Good. Let's try to get serious. The business case for financial health, I think we all very easy to argue that the poor families in the business need finance. The poor families has financial crisis. They need finance. But I mean, you buggered up my program a little bit with your speech. But how many institutions think through what happens when this client now loses a job or loses a project or the business go down? Think through who will this client contact. I mean, you reckon I'm going to run to the loan officer to say, I don't have money anymore. What will the loan officer do? The very first thing he says, contact the collections department to say, this guy can't pay. You better collect soon, because otherwise the competitor is going to take the money. So we have to think from a financial health perspective. If we cannot think through the cycle from when the finance is received up to through the things that will go wrong to the end, then we will not achieve financial health. Because let's be clear, we're providing finance that imply a debt obligation, a monthly debt obligation, plus interest from a family that is already close to the edge. You know, so we've not made their position better. Could they get a cash inflow? Or for the next 12 months, 24 months, in Cambodia's time, 4 years, this client now has less monthly cash flow to come out from than they had before. So we're increasing the financial vulnerability. Good. Let me take a quick side angle here. You know, we've got these gray come from microfinance. I mean, over the last 20 years, how many crises have we had in microfinance? Bolivia, South Africa, Nicaragua, Andhra Pradesh. We can just carry on. And I mean, these are just the big ones. And I was thinking, I mean, I was working on a little article to think now, is this just has there been as many banking crises? There are banking crises, but this regularly? I don't think so. So what is it peculiar to the microfinance sector that causes these repetitive crises? Now, my current take on it, just like the 5 o'clock on a afternoon. Fundamentally here, we are bringing finance to households that has probably never had finance before, that are desperate for finance, whether to grow their business, to buy a plot of land with a family member that's sick, whatever, you know, so they're going to take the blooming finance. They're not going to have that much judgment on whether it is too much or too little. And they may never have had finance before. No, this is like a crisis waiting to happen. Then you add to that, I mean, you're talking, forget these nice lenders that we have here. The average lender, particularly when they commercialize, particularly when they become banks and there's commercial investment, has got growth targets that must be at least 20 times higher than the national growth, if otherwise it's too low. Massive income targets against write-offs, aggressive sales, aggressive collection targets. You combine this with this households that are a bit desperate for finance, things can only go wrong. I mean, and we are talking in countries. I mean, if you go through these crises, in 90% of the cases, it's not that the lender caused the crisis, but that the level of the surplus has been reduced to a level that when something went wrong, things go wrong badly. People don't have that because you've taken that surplus. The lender's surplus now going to the lender. I mean, Cambodia right now, it's not the lenders that caused the crisis. There's an employment crisis. Employment in Cambodia has dropped. South Africa, we had a major agricultural crisis. Bolivia, every single case of these were an external event that came that hit families that had very little space to deal with. So again, from a microfinance industry perspective, that means we've got to give much more attention than I mean, in most of these standards, you won't find debt counseling in these standards. It's not there. How many lenders are there that's got a policy for dealing with over-indebted clients that includes debt write-offs? No, the policy is send them to the competitors, they can get another loan there, or reschedule with a bigger loan size over longer term. This is a very bad, terrible solution. Let me move on. So what can we do? The one thing, we need regulators, and whether the laws are good or bad doesn't matter. You need a regulator that is super, super aggressive. They must give people hell, because there is absolutely no doubt that consumer protection, good standards have a cost to it. If you've got a soft regulator, as the industry always want, then then I can also say I comply. I don't have to comply. So the aggressive guys are going to get away with hell. The good guys are going to take the cost. It's what happened in every single market. Or I mean, South Africa. I mean, I lived through this bad things for a long time. I mean, where the most aggressive lender is the one that sits in Parliament all the time, that has got advertised on it, and that sit next to the minister all the time, and they are as sweet as anything. You go look at what they do at home, and you have to look at the detail. You know, so good. Let me move on. You know, so the point, the more aggressive your lender is, your regulator is, the stronger is your case for the compliant lenders to justify what they do, and they get the payback. If you've got a weak regulator, then it's the aggressive lender that do not comply that's going to have higher growth. It is, read Machiavelli, it's the only way that will happen. It's what happens. I mean, what happened in the financial crisis in the US? Exactly this. Secondly, is we have, I mean, at the institution, I've said it already, is that we have to give a hell of a lot more attention to what do we do as an institution when things go wrong in the clients? Who can the client contact? The loan officer. Are you mad? The loan officer's bonus is dependent upon having low default rates. There needs to be an independent place to contact. How many institutions have a policy to deal with over-indebtedness? By the way, it means rescheduling. It possibly means write-offs as well. I mean, otherwise, otherwise we're just bullshitting ourselves. So you've got the institutions level, and let's not ignore the investors. This is a nice audience here. I mean, it's the investor in, I think, every single market that failed. It was preceded by all the investors piling in, pushing the money down, often or always MFIs that converted to banks. Now they've got nice big heaps of money to lend out. Big heaps of money means high growth targets, low default targets. I mean, it's almost logical. Read Machiavelli. It's, you know, so investors, I think, need to take a hell of a lot more responsibility. Let me put it the other way around. I mean, as a regulator, the number of investors that come to us to say, oh, but your standards are too high. Look now, where have you heard this? This investor put the money in the institution. They sit on the board of directors. They determine the growth targets. They determine the incentive schemes for the loan officers and the management, and they determine how much money is paid on things like debt counseling. They will go crazy if they hear write-offs. So it is the investors in the fundamental analysis that must take primary responsibility for the things that go wrong and for fixing it. I mean, it is a bit shocking in Cambodia now to see all the investors running a mile. The problem has been created by the investors, including, and I'm just being provocative, by the way, including the good guys that built up the portfolio, exited without conditions in that exit contracts for the client treatments thereafter. I mean, if we say that we're investing for the long-term benefit of the client basis, this is not rocket science. This is completely expected. You know, so I think the cycles we've seen so many times, it's very clear what's going to happen. The logic is clear. Read Machiavelli. It was written in 1700s. The human incentives are clear. But what we've not done, I mean, we had a huge workshop in India earlier this year. Very, very few institutions have a policy. Let me put it the other way around. Go and read Basel core principles. You have to have a policy for credit approval, a policy for this, a policy for that. Is there a policy? Is there even a mention of a policy for dealing with clients that's over-indebted? I can guarantee you, no. How many of these standards talk about a policy for dealing with clients that's over-indebted? No, because we think through everything, but this unfortunate reality that some people will have a crisis and will have to work through this crisis because what we at a macro level assume implicitly to say that if things go wrong, the clients must take the pain. And we also implicitly assume the client did something wrong. All the stats I've ever looked at says that 80% of problems with repayment is outside of the control of the clients. But there was huge research in the EU done. All the crises before, it's a family member that died, a drought, this. And the last word in our at the middle income class, I mean, it's a problem in our banking systems, by the way. Our banking systems also make this assumption. Things go wrong, consumer must pay. They're going to suffer for 1, 2, 5, 10 years. They'll be devastated. In the old days, they would have gotten to the debtors' jails. Bentham, this is what Bentham in the UK made his life on, is writing about this. The problem we are sitting here is when we get to microfinance, we are targeting people who are vulnerable. And 80% of the cases, it will be to the benefit of the consumers. I'm not against, I'm proven well, my first job was in microfinance. But we have to give a hell of a lot more attention to what do we do when people cannot repay. Because to implement this, it means somebody's going to have a write-off. And if there's multiple lenders, if we three are lenders, you think I'm going to say I'm me that's wrong, then you have real hell. We have implemented this stuff in South Africa with 200,000 people per month under debt counseling. It's hell to get to the point of saying there must be a reconciliation now and somebody must do a write-off because nobody wants to write off. Hey, enough. Back to you.
So thank you very much, Gabriel. So we'll say that so the power of regulators is limited. We need the collaboration of investors as well in fostering financial health. You also mentioned that we need to be more responsible in lending because also the regulation is weak in terms of, for example, penalizing or penalizing FSPs if they over indebt their clients. Okay, so now just this very final question for each of you. Okay, you have 1 minute, no more, because then we want to open the floor to the audience. So what should we prioritize? So what do FSPs should prioritize, and how can they foster the financial health of their clients? And if there is a sort of roadmap, that they can follow to have a positive impact on the financial health of clients. Trey, are you still with us?
Yep, can you hear me?
Do you have some final remarks on that?
Yes, thank you very much. So from our perspective and our experience, we think that measurement is probably the best place for a lot of FSPs to start. And by that, we mean going out and measuring the financial health and figuring out what the financial challenges and needs are of your customer base more broadly. I think you'll find that there are different needs based on kind of people's current circumstances, but it'll help you identify things like, are one of their biggest challenges right now meeting monthly expenses, or is it generating savings? So you might find out for an FSP that most of their customers are farmers, that one of the biggest challenges they find is they have a big income spike when they sell a lot of their crops, and then they have little bit income through the rest of the year. So thinking about that would be, okay, we did some research, we found out that was one of their biggest challenges. What's the product, or how do we develop a system to help them kind of manage that spike and then have money saved for the rest of the year? You might also have another FSP who has a lot of traders, and they are taking a lot of debt out, kind of what we're talking about, Gabriel was talking about earlier. And you might find that some of them are over indebted. And so you might want to be like, okay, we should be thinking about more of our customer base has this debt problem. What can we be doing to alleviate it? So for us, we think the first place is to start with measurement. And in that measurement piece is also defining what financial health means for your organization and how you would measure financial health. There's different frameworks out there right now. We have one I don't think would translate necessarily to all markets, but I do think the core components of one can be used in other places.
Okay, thank you very much, Trey. Max, do you want to say something about the measurement and low-cost solution for measurement based on, the initial fundings from, if you just to, take the opportunity?
Yes, thank you, Davide. Well, I'm just going to show this original, very simplistic framework that we are working on. Here, there are two very important elements, which is measurement, right? And I mentioned that it's very important. FSPs take also an approach to measuring the financial health of their clients at different points, but also measuring how they are performing after implementing these interventions or strategies to improve that financial health. And those measurements should be, related. So FSPs can easily identify how their interventions are actually making an impact or positive outcomes or results in their financial or institutional performance. So that is when, as Trey was saying, there are a lot of different metrics and different approaches to measuring financial health. And also we are working on how those indicators or measurements can be related to, standard metrics or benchmark indicators, as Nancy also mentioned, that can also reflect how the financial health of the clients are actually impacting on the financial performance of FSPs.
So FSPs, they also have a wealth of internal data that can be exploited and used to measure financial health, combined with surveys and then other data collection methodologies. Nancy, any final remarks?
Yeah, I mean, I'll be quick because I don't have a roadmap, unfortunately. But I think the work of this working group is really important. And as I said at the beginning, I think there's certainly a bit of work that we need to do around the semantics and the language that we're using. It's not necessarily the language that is being used with our partners, but I think that's not to say they don't actually recognize the benefits of having good financial health amongst their customer base, both from a business sense and from kind of moral right thing to do. I mean, we try to find the good guys, and that's what we spend a lot of time doing. So those good guys do tend to recognize and want to try and achieve those objectives. So I think this, what do we mean by financial health? How do we measure it? And really importantly, is that the same as how financial service providers see it and their customers? I mean, what does financial health mean for them? What does it mean in their contexts? Recognizing and understanding that we're not coming from the same starting point. People's financial health needs are going to be very different from country to country, from region to region, so just kind of really paying attention to that, I think, is going to be important. And thinking about whose responsibility it is really. I mean, is it just the responsibility of a financial service provider? They have a part to play, but my opinion is that it's not. If you look at the likes of the UK, I mean, debt advice, I don't think that should necessarily be provided by the FSP. Quite frankly, they're going to be driven by something a bit different. So independent debt advice, is it governments, regulators, charities, educators, financial service providers? So a really collaborative effort, I think, is needed. And definitely investors. I mean, I think investors do have a role to play. And we're quite different in terms of where we're coming from and who our supporters, who our donors are. We have that flexibility in terms of how we finance. And I think that's really important. So we need to be clear around what our expectations are around those financial health outcomes, but really looking at ourselves. Does our financing allow for that? Does it allow for it in terms of the cost of our financing, in terms of flexibility, in terms of the expectations we have as an investor? So there needs to be some work between and amongst investors as well, I think, in order to have the best outcomes around financial health. And the voices of FSP and customers, which I know you are doing, is really critical.
Thank you very much. Gabriel?
Just two or three small points, but I mean, firstly, for finance to expand as it should to all levels of people, it's going to be the good guys that's going to make a small contribution, and the bad guys are going to make a big contribution because they've got big pockets of money. So we need to create a robust system that can deal with the with the aggressive lenders with the big pockets of money as well. So we have to accept that reality. The regulation, I think, is important. A good regulator will play a huge role, but often they're too late. And I mean, how many regulators understand microfinance? How many of us understand the dynamics of a poor family's finances? It's blooming complicated. Yeah, the financial health, I mean, I'm worried about, the only thing that I've got worried about the financial health as a good is one need to really be realistic in terms of where it fits into the profile of the financial services providers' objectives. That's where I completely agree with what the more it can be rational for the financial service provider, the better. Unfortunately, this long term that undermines it, because most people targets their profits for this year. But we really do have to invest a lot more in, because I mean, in 2002-3, CGAP staff were telling us, oh, South Africa's special. It's you guys are full of loan sharks. In 20 years later, it's happened now. Time after time, it's going to happen more and more. These Cambodia type of outbursts. And we have to do a lot more to create. We can't prevent all the problems, but to create mechanisms to throw a lifeline out when somebody's drowning.
Okay, thank you very much. So now it's time for Q&As. Yes. Oh, okay, thank you. Yes.
Thanks a lot. I have a quick one. Don't worry.
Maybe we can take like, the floor and yeah. Please.
Thank you for a really fantastic panel. Enjoyed it immensely. I have a question about who are the clients when we're talking about financial health, because I find that often when we talk of financial health, we tend to assume that the clients are individuals. But of course, there are many places in the world, including countries that my company does research in, where financial health is something that belongs to a family. Often that family is also spread over multiple households, but they're managing their money together. So if one element of that family is affected, then the financial health drops overall. So how do we measure that?
Thank you very much. Yeah. So I think everybody is in favor of financial health, but I think the big question is, how do we get there?
Yeah.
And there are a few assumptions at the beginning that I would love to challenge a little bit. The fact that financial capability leads to change in behavior that leads to financial health. First, I'd love to see more evidence on this. As you know, there is a lot of debates just on the move from knowledge to capability. There are several meta-analyses that contradict each other. I believe that it has, some influence, but not everybody. So, that's something. And then the jump from capability of consumers to financial health, that I've never seen any, data on this. So I'd love to see that if that's available. And also, what do you think are the other factors that are, contributing to better financial health? Because from my readings, it seems that physical health, external shocks, economic situations have even more of an influence on financial health than well-designed, financial services. So I think there's so much being talked about financial health at the moment. We need to understand what is it that we can really achieve and potentially remain quite modest about we as the financial inclusion community can achieve in terms of improving financial health. Of course, you need this whole ecosystem to work. Gabrielle mentioned the regulator and all this. Everybody's going to contribute to that. But, what is it compared with all these other factors that might have even more influence?
Thank you. Maybe my question actually is a practical correlate to this question just now. And that is, Nancy was bringing up the issue of cost. And indeed, I'm wondering if Trey, Nancy, Max, or anyone actually, also Gabrielle and Davide, you've seen practices that are scalable, maybe digitally delivered, that nonetheless lead to, and I guess it'll be anecdotal evidence for the time being, but that lead to change in practices and how people are managing their finance, and therefore a move towards financial health. Because of course, that would be encouraging on being able to deliver something that's cost efficient, even for lower income households and small business holders.
Thank you. Well, I have one question, a comment maybe just for Gabriel, which is you mentioned the responsibility of investors, well, regulation, but also the possibility to work on investors. And what about considering the borrowers also as investors, like in the cooperative model, where the savings, well, you collect savings from the borrowers, and therefore you have a sort of self-control of the process. So regulation, okay, but this should be a sort of self-regulation. Then a quick question to Nancy. You mentioned that you are caring about the financial responsibility of FSPs, but how can you reconcile this with the rule of zero risk and zero interest? And for the two of you, maybe, I followed this group since I've been following for long, but it came to my mind that instead of calling it financial health, shouldn't it be managerial health? Because financial is too restricted to financial flows, profitability, but this is more, an overall change in mentality. I'm not sure, but, maybe it's a stupid suggestion.
Who wants to go first?
Well, I'm happy to answer or make comment of the first question. It's actually very important to identify who the clients are, right, in this approach. And from our theoretical framework, we are taking clients more at the individual level, right? Because this is the interaction or relationship that most of FSPs have, especially the ones which are more commercial led. The other FSPs, of course, look at the household level. And we understand the financial health also is shared at the household level. But that will be more, in this framework, more challenging, right? Because what we are proposing is FSP to increase that relationship with their clients, right? And direct interaction with them through the services and products they provide. And we believe that, improving the financial health of their customers or clients will have ripple effects also within the household. But I think it's an important point also to bring that conversation with FSPs, because they cannot ignore the financial health of the household and separate it, right?
Mm-hmm. And yeah.
And I'll just add to that, I think that's a really important question. I think the whole household kind of what's happening at a household level is really critical and something that's not necessarily paid enough attention to. So you see at the point where you're making decisions around the capacity of an individual to take on the debt, quite often that does include household debt levels, it will include household income levels. But I think then once those initial checks are done, I'm not seeing much more beyond that happen in terms of looking at change at a household level. So like you say, when things start to go wrong, obviously you look at the individual and you start pressure basically starts to be built on the individual to be able to repay. And we're not paying enough attention, and perhaps this is part of this work as well, at kind of those dynamics, the whole household and how they're managing that is really key. And I think a lot of what Care does, not so much on what we're doing because it is this credit side, but is a lot to do with change that household dynamics, particularly for women, when you're managing their finances and debts, and how that dynamic changes as a result of those pressures. So it is, it's a really good point, and something that I think that it's not done as much with FSPs that we work with anyway.
Nancy, do you want also to answer?
I'd like to. I'm not sure I've got the answer to your question. I think it's a question I kind of was expecting, I suppose, in terms of, I think you're saying, I suppose, because we're kind of distorting it a little bit, aren't we, by having the interest and risk-free, I suppose for us and who we are, the social objectives are so critical for us. And we recognize, and we know from our experience with the FSP that we work with, the kind of pressure operationally and financially that's put on organization when they access expensive sources of capital, which is often what they're relying on to fund and to grow operations. And ultimately, we believe that when those costs build, they get passed on. Eventually, they're going to be passed on to the customer. That's what we see happening. And so fundamentally, we're trying to kind of stop that from happening. I didn't mention that in addition to it being interest and risk-free, we also lend in local currency, which we think is important because we've seen over time that lending in hard currency adds another layer of cost and risk for an organization. But we think, I mean, it's something that we're concerned about, and we haven't seen, I mean, our impact is different across our partnerships. Some of our partners are quite big, and so the amount of capital that we provide is quite minimal, and we're one among many investors in their portfolio. And some we are the main or the only, depending on their size. And to be honest, obviously that makes a difference, but I haven't seen that involvement from us as Lendwithcare and Care over the years have a negative impact on financial sustainability or financial performance. So it's kind of anecdotal, but I take on board the point, and it's something that's been put to us a few times, and it's kind of where we stand, I suppose, in terms of what we think, what we prioritize.
Okay, thank you very much. So concerning the drivers of financial health, so the last year, for example, we had the Amric from FSD talking about their measurement of financial health and the drivers of financial health in Kenya, and they focus mainly on macro level factors such as an increase in unemployment rate, especially people working more in casual labor, increase in inflation rates, so the cost of living, the cost of education in Kenya that has increased. So we are aware that there are many factors that affect financial health. It's not only about financial capabilities. I mean, we also there are financial behaviors, attitudes. Okay, so our contribute can be minimal when there are macroeconomic shocks. We are aware of that. But the idea is to increase the resilience of people also, to be able to manage.
We invite you to join us in the Agora for the cocktail and the lounge of Sunflower Seats. Agora, ground floor. Thank you.
Okay. Okay. Trey, maybe do you want to say something, and then I give the word to I don't know if there is some question I want to pick. Have you?
I think can I jump in real quickly about the cost question that somebody asked, and about the scalability. I think from our perspective and what we see in the US is a lot of people start off with surveying, which I realize can be a pretty expensive practice. You can use transactional data to measure someone's financial health. It's a little bit more complicated, but you don't have to have the additional cost of going out and reaching out to people and trying to do the surveys that we've kind of talked about before. So as people are thinking about different ways to do measurement and thinking about ways that this could happen at lower costs, I do think if you have a picture of somebody's savings and loan portfolio, you'll get a part of it, because I'm sure that they've got some things in informal systems that you might not be able to collect, but you might be able to get a general idea of what your client base is looking like and what they are struggling with and where they're at with their finances. But again, they might be imperfect because of the informal systems that are already going on. The other option is surveying, which I know can be an expensive way to do this through either IVR or through your text SMS messages.
Okay, thank you. With regards to successful cases, for example, the last year we had the case of UNCDF project on Malaysia, where they work with fintech companies to promote the savings behaviors of workers in I don't remember now the name, but in riders or in the
rickshaws or
so with not stable work, so they collaborated with, and now there is now available online on the there is the UNCDF set up a community of practice on financial health, and the website is there, and there is I mean, there is a lot of information there, case studies that you can look for. Gabriel, any about
the audience are tired of us, but
yeah, but maybe
They want to have the
I know that Laura is Yes.
2 or 3 of the comments.
Oh, you can
Yeah,
talk.
we
Yes,
can-
yes,
yeah.
yes.
2 or 3 of the
So, yeah,
comments.
the cocktail is cocktail, so we don't want you to keep. Yeah,
Yeah.
or water, yeah.
There's
Okay.
one comment.
Yeah,
Quite a few of the comments and this whole financial education drive seems to put the responsibility on the consumers to protect them from the lenders. It's not work in mainstream finance. Why
Yeah.
the hell do we think it's going to work in low income finance? You know, it's the responsibility of the lenders to make sure that the products are and the mechanisms are there. And it is the responsibility of the investors to say, if this and this is not in place, we will not invest. So the big boys that invested in Cambodia, they cannot take responsibility. I mean, it's not, you will never, through consumer protection, consumer education, resolve these things. It's
No,
the lenders
sure.
that's got the power. And you've got to deal with the lender side, and the investors has more power because they've put the money there.
sure.
It's-
Yeah. So thank you very much
Thank you.
to everyone for remaining with us in the end. And enjoy the cocktail. And
Thank you.
of course.
Take